Hello and welcome to Looking at the Markets with David Modell. Can you get paid $200 to buy shares of stock? Actually, you can by trading options, but you need to know what you're doing. Options are very risky and you could lose a lot of money if you don't know what you're doing. So make sure you have a mentor, make sure you learn about it before you even consider trying to do it on your own. And I do coach people for stocks, options, trading, investing, all that good stuff. So if you want coaching, you can email me. It's on your screen right now, davidmodell@gmail.com. So you want, first of all, to have options trading permission with your broker if you want to do this. So if you don't have options trading permission, and you want to have permission with your broker to sell cash-covered put options. In other words, you sell a put option and you have enough cash in your brokerage account to buy 100 shares per contract. All right? So, and you're going to buy the 100 shares at the strike price if you get assigned. All right, so let's take Canopy Growth Corp stock. Right now it's trading at $24.01. And let's say I wanted to buy 100 shares right now. Okay, so I would place an order. I would buy $2,401, and that would be 100 shares. And I might pay a fee or commissions. And this is the Schwab website, by the way. So usually you don't get paid to buy shares of stock. Usually you end up paying. Or it might be a fee-free or commission-free broker nowadays, but still you probably won't get paid to buy 100 shares of stock. But what if I sold a put option, a cash-covered put option? So we're assuming that I have at least $2,400 in my account or more, and so I would be able to buy 100 shares. Okay, and let's say I really like this company and I really like this stock, and I think it's going to go up, or at least go sideways, but preferably go up. Okay, well, I could buy 100 shares right now, or I could place a buy limit order, let's say at $24, and I could tell my broker, okay, let's buy 100 shares if it goes down to 24 exactly. All right, so with a limit order, I could buy 100 shares at $2,400. But again, I probably wouldn't get paid to do that. But how about doing this instead? How about selling a cash-covered put option? And that way, you could set the strike price at 24. And so if the stock price goes below 24, which it probably will because it's already at 24.01 cents, so there's a pretty good chance it'll go below 24 at some point. And if it goes below 24, there's a pretty good chance that I will be assigned and I will end up buying 100 shares at $24, which is what I was going to do anyway if I was going to put in a limit order at $24 to buy 100 shares, or if I was just going to put in a market order to buy 100 shares right now, then I would end up buying it at around 24, maybe a little bit higher. So if I was going to buy 100 shares at 24 anyway, why not sell a cash-covered put option with the strike price at 24? So I'll end up buying 100 shares at $24 each for a total of $2,400 if I get assigned, which I probably will. There's a good chance. Not necessarily, though. Now, where do I put the expiration date? Well, what's oftentimes recommended is 45 days out in time, or close to that. Between 30 and 60 days is often recommended, and as close to 45 days as possible is often recommended. And I've found that to be a pretty good guideline, between 30 and 60 days. Try to get it close to 45. I couldn't find anything exactly 45 days, but November 1st, well, that's 38 days. Okay, so that's pretty close to 45. So that way you get some pretty good theta decay or time decay. And as a seller of options, you like it when time passes. You like it when there's theta decay or time decay. So look at what I would get paid if I sold one contract, one cash-covered put option contract. I would get paid a little bit more than $200 for the contract. $2 a share times 100 shares, that would be $200 immediately paid to my account. Now, 200, let's say maybe I got it at the mid price for $213. Well, there would be some commissions in there, so it would be about $200 credited immediately, cash into my account, a cash credit. And that would be my $200, give or take a few dollars, to keep. I would get to keep that no matter what. I would have to pay taxes on it. All right, next year at around April 15th, I would have to pay taxes on that income. But still, immediately I would get around $200 just to potentially buy $2,400 worth of Canopy Growth Corp stock. I happen to like the company. I happen to like it at $24 a share. That's a pretty good price, I would say. So why not sell a put option? I could get paid $200 to buy $2,400 worth of stock. Not too bad. Not too bad at all. That way, even if the stock went down to 22, I would still at least be break even. I'd be breaking even there, right? Now, what would happen if, let's say I sold the cash covered put option, 24 strike, 38 days out till expiration, and the stock just went sideways? It stayed at 24, or maybe it went up and stayed up for the next 38 days. Well, in that case, I would almost certainly not get assigned. I would not purchase 100 shares of Canopy Growth Corp stock. Okay, but I'd still get to keep the $200. That's cool. I'm okay with that. I would get $200 for free. Not too bad. So, hey, what's so bad about that? All right. Now, if you really, really, really want to own 100 shares of the stock, then this is not the way to do it. Because there is a possibility that Canopy Growth Corp might stay at around 24, or it might go up, in which case you would probably not get assigned and not own 100 shares of stock. All right. That will probably only happen. You'll probably only get assigned if Canopy Growth Corp goes below $24 a share. But that's reasonably probable. That's very probable, considering it's already down to 24.01. It's only a penny away from 24, and there are 38 days until expiration. So it's probably going to happen. Yeah, you would probably get assigned, but just be aware that's no guarantee that you'll get assigned. I like the idea of getting $200 immediately. You get to keep it no matter what. Just don't forget to pay taxes on it. All right. Here's another example. Twitter. I put the same expiration date, November 1st, and so that would be 38 days out once again. And I did that for all these examples. All right, trying to make it as close to 45 days out as possible. I put the strike price at 40, and so if I said to myself, I would be willing to buy right now 100 shares of Twitter at $40 each. Okay, right now it's $41.42, so that would already be a pretty good discount compared to the current price. But not only that, well, first of all, it might not get to 40. Okay, but if it did, I'd love to buy it at that price, 100 shares, and I have $4,000 in my account. It's cash covered, right? Don't do this unless you can cover it with cash, unless you can afford to buy 100 shares and you're willing to do that. Well, if I sell a put option, I could get paid a couple $100. How do you like that? Let's say if I got the mid price, I would get $214 minus any commissions and fees, cash up front, immediately credited to my account. Not bad, right? Once again, get $200 just to buy 100 shares of stock. Now, I could only do that if I have $4,000 in my account. Okay, but getting paid $200 to potentially buy $40 worth of stock, of Twitter stock, if I like the company and if I want to buy it at 40, great, not too bad. Now, let's say I want to get paid more. I mean, keep in mind, I would probably only get assigned if it went below 40. Okay, no guarantees. You might or might not get assigned. But I would love to buy Twitter at 40. That's a pretty good price. Let's say I wanted to buy more. Let's say I want to get paid more. Then I would put the strike price higher. Let's say I put it at $41.50. Man, I could get $288 minus commissions, let's say, if I got the mid price here. Not too bad. Now I'd be buying it at at the money or close to it. I'd be buying it 41.50, not 41.40, or not 40. So I wouldn't be getting as favorable a price when I buy the shares. But man, it'd be nice to get paid $288 up front minus commissions and fees. Not too bad, right? But I kind of like the idea of buying the out of the money 40 strike. I'd still get a couple $100 up front, and I'd be buying Twitter at a really great price then. Let's look at some more examples. Kronos Group. How'd you like to buy? Buy it at $9 a share, not $9.36. Okay. And I like the company, and I have $900 in my account to buy 100 shares with if I get assigned. All right. And that would already be a significant discount from $9.36 to $9. That'd be a pretty good discount already. And now it might not get there. Okay, so if I really, really, really wanted to buy 100 shares, then I would just buy 100 shares. Because when you sell a cash-covered put option, you never know whether you're going to get assigned or not. You might or you might not. Even if Kronos Group went below 9, you still might not get assigned. So there's always that possibility, or you might. You could get assigned at any time, even at any price, really. But I would like to buy 100 shares at $9. And I'd like to get paid, let's say, $60. Not bad, right? Get paid $60 up front to buy only $900 worth of stock. I mean, I say only $900, if you have a small account, that's a lot of money. And if you cannot afford this, I understand. But, just compare the amounts. Getting paid $60 up front to buy $900 worth of stock, that's pretty good there. And you get to keep that money no matter what. U.S. Steel, another example. How about buying $1,050 worth of U.S. Steel, which again would be a discount to the current price of $10.71 a share, and I'd get paid, let's say, $77 mid-price up front, minus commissions and fees. Not bad. Get paid $77 to buy a little bit over $1,000, $1,050 worth of U.S. Steel stock. Now, only do it if you believe in the company and you think the stock price is going to stay the same or go up. Don't buy it if you think the stock price is going to tank. That's not the idea. Freeport-McMoRan, FCX, another example. It's practically at the money here. $10 a share. Yeah, I could either buy 100 shares right now at $10.01. I could set a limit order for $10, and if it goes below 10, which it probably will at some point, then I could buy 100 shares and not get paid anything, or I can get paid over $50, let's say around $56 minus fees and commissions, to buy 100 shares at 10. Not too bad, right? Getting paid to buy stock. And so it's a pretty good ratio. I mean, think about that. That's you're getting paid 5.5% of your purchase. If you buy $1,000 worth, you're getting paid $50, $55, $56. So I'm getting paid 5.5% of my purchase amount to make that purchase. Not bad. Marathon Oil. All right, I'd like to buy it at 12, which is a discount from the current price of $12.22. I'd like to buy 100 shares. I have $1,200 in my account. Why not get paid almost $60 minus fees and commissions right up front? Not too bad. That would be about 5%, almost, of my purchase price for 100 shares. Pretty good. General Electric, GE. All right, I wouldn't get paid a ton of money. $32 minus fees and commissions is not a ton, but I would only have to buy $850 worth of it. Pretty significant discount from the $8.97, almost $9 price. I'd be buying it at $8.50. Let's say I wanted to get paid more. Okay, I could make it $9. I'd get paid a little bit over $50 minus fees and commissions. Pretty good. Only having to commit to buying $900 worth, and I get paid $50 up front or so. I say only $900. I mean in comparison to some of these other ones I mentioned, which would be more expensive. All right, one more example. Ford stock. It's at $9.11. I'd like to buy it at $9. I'd be willing to do that at some point within the next 38 days if it goes below 9. And I'd like to get paid $34, let's say, minus fees and commissions up front to buy $900 worth. This doesn't pay as much because Ford is not a big mover. as a stock. Notice that the down move today was not nearly as steep as the other ones I've been pointing out, okay? So that's something to be aware of. But you do want to wait until the stock is down before you do this in most cases, because you get paid a lot more, all right? If this were green, if the stock had gone up, then I wouldn't be able to get $200. I would get a lot less than that, all right? So Ford was only down moderately, but it's not a big mover, so that's typical, usually. So I'm not going to get paid as much, but it is a safer investment. $900 worth of Ford Motor stock is a pretty safe investment compared, well, I mean, I'm not telling you it's safe. Nothing in the stock market is completely safe, but it's safer maybe or less volatile than Canopy Growth Corp or, something like that, or U.S. Steel or Freeport-McMoRan, as you can see by the size of the moves. All right? So get paid to buy stock. Yes, it is possible. It is doable. And if you want some more help with that, again, you can email me, davidmodell@gmail.com. All right? Something to think about. But only do it if you know what you're doing. Don't risk any money you cannot afford to lose. Make your own decisions. Don't do something just because I like the idea. Do it because you decided it's a good idea. Okay? So thanks a lot. I appreciate it. I'll talk to you again soon.